Welcome back to another video. So in this video, we are going to go over the mechanisms of traps. We are going to break down what are traps, trading trap breakdowns, and how to avoid traps. So let's jump into it. So trading traps, what are they? Trading traps are set by market makers to entice traders into a trade and then reverse the trade on them. So basically, when you guys are trading, there's a lot of times, I'm pretty sure yourself, myself as well, have been caught up in certain situations where a trade looks very, very exciting. It looks very, very good. As soon as you get into the trade tends to reverse, right? So you might see, let's say, a breakout point. This is a breakout level, a resistance level, a stock breaks out a little bit. The moment you enter, the stock tends to reverse. Now, these are trading traps set up by market participants, right? Maybe institutions, maybe market makers, where they set these plays up for us to fall into it so they can trap us and take our shares or dump their shares. It's very, very important to understand this breakdown because as you guys are trading, like I mentioned before, trading isn't as simple as just starting from point A to point B where, hey, we should buy a breakout. Hey, we should buy a breakdown. Hey, we should buy a stock that's rallying or buy a chart pattern, whatever the case may be. What you guys have to understand, trading is a little bit more complicated. You have to think outside of the box. The reason a lot of people lose money is because they think inside of the box and they think, okay, I read this in the book, I read that on that book, or I saw this on a YouTube video, so I must follow this. What you have to understand, once again, and this is super important, guys, so pay attention. What you guys have to understand is you should always think outside of the box. You should always look at the bigger picture. You should always look at the market dynamic and understand what is happening and why is it happening so you don't get caught up in traps. So now, another thing with traps is sometimes, like I mentioned, a breakdown. A stock may break a level of support and the first thing people do is people short. Why? Because it looks like a very straightforward trade. These are trades that are set out by market participants, guys. They're set out for you to get trapped. And that's why a lot of times when you get in this trade, when you're shorting, you get in and the trade reverses, right? Because these are the trap setups. So understanding these traps, understanding these points are very, very important on understanding price action on a deeper level. Now next, where are trading traps set? So trading traps are set on areas of breakout, areas of retracement, around levels such as support and resistance, and at times you find them on chart patterns, which is why I mentioned this in the chart pattern section, that chart patterns do not always work. A lot of times they are set out for you to get trapped, and then once you enter it, you may think that, wow, this chart pattern is showing me the best entry point ever, but in reality, they may be trapping you, and the next thing you know, the trade goes against you. Right. Now, let's understand trading traps on a deeper level. So there's something called liquidity pools. So what that is, right, is what happens here is, let's say a big institution, or let's say even you have 10 million shares of a stock. If you want to fill a big sell order in a certain price, you need lots of buyers to buy from you, right? Once again, let's say that stock ABC, right, is trading at $30. You want to sell, let's say, 1 million shares at $31. Right? Now, what you have to understand is the moment you show the world that you are looking to sell 1 million shares at $31, there's a very high probability that the stock may go down because people see a huge sell order. So you are not going to show that sell order. Now, we retail traders, we're probably not going to be trading with this size, but a lot of big institutions, they're trading with size. 30 million, 300 million, $1 billion, and so on, when they enter trades, they cannot enter and exit right away. So what they tend to do is if they need to take off size and if they have a lot of shares of a certain stock, they create certain traps. So they create fake demand. So fake demand is created in that price area, which then traps the buyer. So for example, you might see something like this. This is resistance. Stock is unable to break resistance, right? It's unable to break resistance. Here it breaks resistance. Now at this point, what happens is fake demand is created. That fake demand that's created showcases or is showing at that moment that this stock is breaking out, that it's going to go higher. Now, the reason this fake demand is shown, the reason this fake demand is created is because the people that got in here and have a lot of shares, I'm not talking about 100 or 1,000 shares, I'm talking thousands and thousands of shares depending on obviously share price and so on. People have millions of dollars invested, a lot of institutions. What they tend to do is they need to get out. So they create this breakout, right? And as they create this breakout, a lot of people are like, yes, it broke that level. It broke this, let's say, $35 level. We should buy. So that buying creates a lot of buying pressure, and that buying pressure allows this big institution that owns a lot of shares that wants to offset their shares, they now found potential buyers. But now if they try to do it here, let's say they try to do it before the breakout, if they try to sell a lot of shares here, they may not have a lot of potential buyers or people interested in the stock at that moment. Interest kicks in here. So once they showcase the interest, they start dumping, the liquidity starts dying out, the interest starts dying out, boom. And what happens here? This is where dumb money gets trapped. This is where when you're taking on certain trades, you're getting trapped because you're not understanding this concept. The concept that a lot of people understand, and that this is a concept that I don't want you to understand, and I want you to eliminate this, is a simple, straightforward concept. Oh, a stock breaks out, we buy. Stock breaks down, we sell or we short. No, guys, it's more complicated than that. There's much more to it. If it was that simple, trust me and believe me, everybody would make money. Oh, if it's a triple bottom, right, that means the stock is going to go up, right? No, these are set out by market makers. These are set out by market participants. They create these fake setups for us at times where we get trapped. And understanding that is extremely important, because if you can sometimes be on the other end of it, you might be able to capture a very high profitable move. Now, let's break down two concepts. So we have something called a bull trap and a bear trap. So big breakout trading declined with the introduction of AI and quantitative trading bots in the recent years. So usually these bots can easily see the depth of market orders and trap traders in main levels, which causes traps. So basically, after AI came out, after a lot of systematic trading came out, and a lot of you're trading against algos and so on and computers, they're able to see where a lot of orders sit. They're able to see a lot of order size. They're able to read order flow. The systems are able to read all of this. So as they're able to read all of this, they know where dumb money is going to enter. And dumb money, in simple terms, is a lot of us retail traders. We're considered dumb traders. We're considered dumb money. We are the ones getting trapped. Now, as you guys read more books and go back in the 80s or back in the 90s, a lot of these methods work. Breakout trading, breakdown trading, simple, straightforward. Nowadays, it's the opposite, because a lot of people used to trade breakout trading, or maybe using the moving average depth cross, whatever it's called, right? Using all these different techniques. They don't work now. They don't work because of AI, right? Because of how advanced we have come along with technology. So these things do not work. What we have to do is we have to say, okay, times have changed. We understand trading is not that simple. We understand that a lot of these plays are traps. So our job is to kind of be on our feet and say, okay, is this a trap? Should I wait for a pullback? Was this a strong breakout? Was this a fake breakout? What happened? So in a bull trap, and I'm pretty sure, once again, a lot of people get trapped in this, you can see, gets rejected, finally breaks out. People go, yay, it's breaking out, let me enter. And then dumps. Same thing here. People see, okay, buyers are stepping in, buyers are stepping in, buyers are stepping in. Okay, buyers are not stepping in. Let me short. Boom. The whole idea of this is, like I mentioned, market participants create these fake setups because they know that if they can get the price up a little bit away from this area, there's a high probability that that will create a lot of interest and a lot of people will enter. And if a lot of people enter at that point, they will be able to dump their shares. And if they do the same thing here, they'll be able to maybe buy at a cheaper price, right? So the whole idea is to trap us retail traders. So when you guys are trading, you have to think a little bit differently. Now, if you're someone that just started trading and you're getting all this content, fresh and you've never looked into other stuff, great. But if you're someone that has been trading, this set of information should really, really stick out to you. Because if you don't think in a different way and you keep thinking the same way that you have been for years and years and years or months, whatever the case is, you're going to lose money. You need to switch that way of thinking around. You need to understand that a lot of the market is manipulated. There's a lot of fake trades, fake demanded trades that are showcased for you and I to get trapped in. We need to be smarter and say, okay, this looks like a trap. No, this doesn't look like a trap. And I'll show you how to identify those, but you need to be able to look at everything from a macro standpoint of view, a larger standpoint of view, right? Now, what happens with these traps is for them to trap us, they have to give us something called entry fees. So we get entry fees from a lot of the market participants. So it may be market makers. They may give us entry fees where when we look at the entry fees, we're like, okay, this looks like a great setup. Wow, the stock is breaking out. So what we do is right away we enter. We're like, wow, this is super cool. This is super attractive. What a phenomenal trade. The moment we enter and we get trapped, what do you think happens? Trap goes off, stock dumps. We need to be careful. We need to understand this. Just understanding this component alone, guys, is very important. That itself is going to put you ahead of the game. Now, understanding it is one part, right? Because now you're already ahead of the game, understanding how, market participants are trapping you. The next component is, okay, how do I avoid it? How do I avoid getting trapped? How do I know if it's a trap? How do I know if it's not a trap? That's the second component that you need to understand when you're trading. Now, I'll show you guys a few examples of how, these fake entry signals are given to us. And how we get trapped, and then I'll show you ways to avoid it, and these are ways that I want you to apply, right? I want you to apply these ways when you're trading, and I want you to be on your feet. I want you to think about everything. Obviously, don't overthink, but when you're applying all these concepts, I want you to think and understand. Is this a trap? What's the market dynamic? Am I looking at multiple time frames? Is this a strong breakout? Is this a weak breakout? What's volume showing me? What's this showing me? All these things are extremely, extremely important, okay? All right, so we're looking here. We have a 15-minute time frame and we have a 5-minute time frame. So I'm looking at two different time frames, right? Like I mentioned, when you guys are trading, you need to do a top-down approach, right? You work your way from a higher time frame all the way down. Now in this situation, I worked my way down from a daily time frame to an intraday. So I didn't just start from a 15-minute. I would never just start from a 15-minute time frame. I, once again, like to start from a higher time frame, such as a daily, and then work my way down maybe to the hourly, then the 30-minute, and then maybe the 5, right? I'm not going all the way down to the 15 and 5 right off the bat. Now, as I do my top-down approach, and I work with the higher time frame, and I work my way down, I see that this is the 15-minute, and I see this is the 5. Now, obviously, the difference is in the 15-minute, each candle represents 15 minutes, each candle here represents 5. So there's a lot more candles, a lot more noise here than at this point, right? Now, if you guys take a look, this right here, resistance, resistance. Right here, resistance, resistance. Now, if you guys take a look here, this looks like a breakout, right? This looks like a breakout. Now, what people tend to forget and where people tend to mess up is they don't understand the market dynamics, as I mentioned, and they think, okay, it's breaking this level or it's breaking this point. That's a breakout. I should immediately buy. Now, if you trade solely off that, and these are the questions I want you to think about, is you're going to get trapped a lot because you're not looking at the bigger picture. If you look at the bigger picture and you understand, and you just think about it for 1 second, just think about this for 1 second. If trading was this easy, all you had to do was wait for this and buy, everyone, I mean everyone would make money. The reason a lot of people lose money besides the psychology aspect and the emotion aspect is because they look at trading and they're like, okay, buy. Trade goes against them and they're like, oh man, that was a good trade. Why they go against me? Because you are getting caught in the trap. These are the traps. This is the entry cheese that is being put out right here for you to go after and get trapped, right? In this situation, we can't primarily see what the entry cheese is. The main entry cheese that we kind of see right now It's obviously a small breakout, but the main thing that we got to understand is how do we avoid it? How do we know it's false or not, which I'm going to break down in a bit. But what you have to understand is in breakouts, like I mentioned before, if something goes into breakout strong, I want to see a pullback and I want to see buyers are still there. I want to see interest is still there, right? Now, once again, 15-minute, 5-minute, you can see it's going up, it's breaking out. This is where fear of missing out kicks in. This is where people that are watching here are like, oh man, I could have bought here, I could have bought there, I could have bought at this point. They're like, oh man, I missed out on profit, so they don't want to miss out on more, so they enter. This is where dumb money starts entering. Now, if you go to the next one, this is the 5-minute chart, 5-minute chart. Look what happens. Stock goes to 52.45, right? A high of 52.45, and then boom, gets rejected. So the only thing that happened here is the people that bought in here or people that bought in around here, whatever the case is, they are offloading here. They are letting the stock price go a little bit higher, and this is where market makers kick into. When market makers see certain opportunities to make money, they will take advantage of that opportunity and they will make their money. So this is where market makers, market participants are kicking in, and they're driving the price a little bit higher at this area. They're not, what I want to be very clear on, market makers are not taking the price from here to here. That's like, they don't have the power to do that. But what they can do is if the price is close to this resistance level and they see that it's probably going to fall, they'll say, you know what? Why make the price fall here? Why not just push it up a little bit, right? Put on a little bit of risk. If it gets pushed up, it's going to attract more people because of a breakout, and a lot of dumb money is going to enter. And when dumb money enters, we are going to offload our shares. When we are done offloading our shares and the selling pressure kicks in and they're unable to hold the buying pressure, the stock will fall. And that's exactly what happened in this situation. You guys can clearly see. Stock goes up, not a strong breakout, boom, gets rejected, a lot of selling pressure. Now, obviously, we see it like this now. But what you have to understand about trading is you have to understand about it in the moment. Forget this chart. This is the after. Look at the before. This is during. During, I'm pretty confident that most people watching this, right, when they see this, the first thing they're going to do is they are going to buy. Right now, it's very easy for you and I both to say, no, I wouldn't buy. I would not buy this. It's clearly in the rejection zone. Yeah, it's in the rejection zone now because we see it. But in the moment, it's like, wow, it's breaking out. And what if it keeps going higher? I don't want to miss out on it. I don't want to miss out on it. I need to get in. I need to get in. I need to get in. You buy, and they're offloading, and boom. And that's what happened here. All right, so it's very important to understand that, guys. Just understanding that concept itself is going to help you out a lot. It's going to allow you to think in different ways. It's going to allow you to look at the market from a different perception, right? And that's extremely, extremely important. Now, let's look at another chart. This is kind of the same stock, but let's take a look at this. Same exact thing. Demand zone, supply zone, resistance area. You can see constantly stock goes right through it and then picks up same area again. Just understanding these components, understanding that, hey, this was once resistance, resistance, resistance. It's the resistance area. Everyone can see that. And then in this situation, you can see how the stock goes up, gets rejected, right? As it gets rejected, look how it aggressively falls. Remember, with breakouts and breakdowns, if I want to short, I don't care if this is aggressively falling. I want to wait for the pullback in this situation because this already took a huge move down. So that's very, very important to understand. Now, second thing, most people right now can look at this chart and say, hey, this looks like a terrible short. Why would I short this? This candle is not giving me a short signal. Yes, the candle right now is not giving you a short signal. I agree. But at one point, guys, this candle didn't look like that. This candle looked like that. It was a strong red candle. Now, understanding price action, seeing 4 or 5 straight big heavy red candles already scares me. There's already a lot of selling pressure here. So what I would want to see is I would say, okay, well, that happened, right? At the moment the stock went under this area, and this is another thing you guys have to understand, and like I said, it's all about understanding these components. So when you're trading in front of a real chart and you have real money invested, you can put all these components together. The other thing with this is when the stock did look like this, the reason it looked like this is because think about it. How many people do you think had their stop losses below here? A lot, and a lot of people most likely had their stop losses below that. So the moment the price got close to that, market makers were now able to bring the price a little bit down, make the candle look like that, right? The candle once again looked like this, a full strong red candle at a point, and then once they took the shares, they were able to reverse it because the selling pressure was just not there. And what did they do? They made money. Now, obviously, this could go a lot of different ways. We already seen what happened with this, but a few ways this could go: a strong sell-off, pullback, continuation. But you have to understand that continuation move would not be taken until the stock breaks that point. But right now, it's not giving us that confirmation. Right now, it pulls back, right? Goes right into demand, consolidates, trades sideways, resistance, 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 breaks out of resistance, goes right into demand again. Now, obviously, if it can hold this level and show a continuation, that itself will give us and show us a very high confirmation that this may possibly keep going higher. So it's very important, once again, to understand why our traps are set. They're set because the market sometimes needs liquidity. People need to exit their position, so they create these fake setups that trap us retail traders, and we need to be smarter than that. We do not want to get trapped into these positions and end up losing money. And now sometimes the traps are set out because there are stop losses. Those stop losses cause the stock to go higher or lower. Now think about it, for example, right? Let's say at this point there's a stop loss at this level, and let's say this is $100. The moment the stock goes above 100, all the people are getting stopped out, which is creating more buying pressure, driving the stock higher, and the same thing goes here. People have a stop loss. Let's say this is $80. The moment the stock goes below 80, the stop losses are kicking in, driving the price lower because there's more selling pressure. Once the stops kick out, once the stops have ended, now there's a higher possibility of the stock going up because that was triggered because of stop losses, because of automatic sell orders. So putting those pieces together gives you a huge advantage on understanding price action on a deeper level. And that's what I want you guys to understand. I want you to understand price action on a very, very deep level so you can actually trade different components, different charts. When you see any type of stock, you can understand it from a macro point of view. Okay, let's look at one more. And then I'm going to show you how to actually avoid getting caught in traps. Same thing here. You guys can see in this situation. Stock goes up, gets rejected. People are getting trapped, gets rejected. So we already know from point 1 and 2 that this is a rejection zone. This is resistance. This is supply zone. Goes right there again, gets rejected. Now in this situation, this is where traps happen for a lot of people. Now in this situation, let's ignore all of this. Right here, this looks like a good breakout. Let's say it has high volume. Cool. Strong green candle. Cool. Breaks out. Candle closes above resistance level. Cool. Everything looks good. Now, when you see something like this, what is the problem with this move? The problem with this move is that the move has not taken a break. The move is just going higher and higher. Now, when you see something like that, me personally, at times, depending on what the trade is, sometimes, not every time, I like to wait. I'm like, okay, cool. What's going to happen after this candle? Now, if I see this red candle, that's still cool. I don't care because, you're going to see red. You're not always going to see green. Now, if I see that, now my question is, okay, are buyers going to step in or was this a trap? If this was a trap and maybe these were stop losses that got triggered, maybe this was set up by market participants for people to get trapped, then I don't want to buy. I'm not going to buy this then. So I wait. I'm like, okay, what I want to see now is I want to see buyers step in and drive it higher. If the buyers can step in and break that point, whatever point that is, that's going to show me confirmation that there are buyers, real interest sitting here that's willing to drive this price higher and higher. But if I see that it's not, and the price tends to go down, I'm like, okay, It was a trap, and at times I'll maybe buy puts or maybe I'll short the stock depending on whatever stock it is. And that's the whole idea of putting the pieces together. But I want you guys to once again understand is I want you to understand these ideas. I want you to understand the market on a deeper level. The idea most traders have, and that's the same idea I had when I started, was the simple idea of trading. There's a deeper level of trading. There's a deeper understanding of why prices go up, why prices go down. Stops are getting triggered. Fake demand is being created. When you start seeing these pieces, you're able to put the puzzles together. So when you do trade, you're like, okay, this is why this happened. This is why that maybe happened. Okay, I'm putting the puzzle together and things are starting to make a lot more sense. Now I'm going to show you how to avoid these fake trades, how to avoid the fake demand, what you need to look into. So let's jump into that right now. Now to avoid traps, the first thing you have to focus on is you have to understand the market dynamic. Now when I say understand the market dynamic, it can mean what is the trend? Is it on an uptrend? Is it on a downtrend? Is it on a sideways trend? Is the market rallying? What's going on? Is there any major economic news? Now this is if you are trading on a larger time period. Maybe you're trading on a 30-minute, 1 hour, daily, whatever the case is. So understanding market dynamic is always a very, very important thing to know, knowing what's happening, right? So for example, let's say a stock is selling off, it breaks support, it goes down, and the stock is now coming back into resistance. Now obviously, if it breaks that resistance a little bit, I would wait for maybe a pullback, or maybe I would wait for the market dynamic to change or see if there is a change before I get into the trade. That's the first thing, right? Second, I'd want to see how strong or weak the breakout or breakdown is. So let's say this is resistance and the stock is going right into resistance. It's doing something like that. At this point, I'd want to see a pullback or I'd want to see a consolidation. This breakout is a lot different than seeing something like this. Something that consolidated, something that took a break after it made a big move up, right? Now this breakout looks a lot more stronger. Now this does not mean that this could not be a fake trap. This could also be a fake trap, but just understanding the move up helps you decrease the chances of you getting caught up in a trap. All right, next, watch time and sales on breakouts and breakdowns. So let's say this is at 3250 level. If I see that the stock breaks 3250, I want to watch the tape and I want to see what's happening on the tape. I want to see if there's a rush of 1,000,000 orders going through, because sometimes you guys are going to notice this when you watch the tape. You'll see a lot of orders kick in. Right when it breaks a critical level, a lot of orders are going to kick in, and I'm going to show you a lot of live examples of these once you get to the different parts. There's going to be a lot of breakouts where time and sale is just going to show you a lot of orders, and the price is going to go higher. That at times is just showing you there's new interest kicking in, and that new interest could be stop losses, people placing market orders, a lot of different things can happen. And then once that interest does die down, if it's fake interest, stock tends to pull back. Me, I like to wait for that pullback or that consolidation and then enter. Right, so watching time and sales on breakouts or breakdowns are extremely important. Wait for pullbacks, right? Waiting for pullbacks is going to help you not really always avoid traps, but it's also going to give you higher confirmation. So if you see a stock breaking out, sometimes waiting for that pullback or waiting for a consolidation period is much better than always entering on the first breakout. In simple terms, guys, let me just put something in the most simplest terms out there. If a trade looks very easy, right, it's probably going to shake you out. It's probably going to fake you out. Wait for the pullback. Wait for another confirmation. I'd rather get in here. Not there, that's way too high. I'd rather get in here than try to get in on the first breakout, especially if something doesn't look that strong. And then last two things, use multiple time frames and wait for the candle to close on intraday time periods. So always use multiple time frames, right? Now the reason for multiple time frames is it correlates with this, wait for the candle to close. Now this is something I've noticed a lot of people make mistakes on breakouts, right? And I'm going to explain it in a very simple way, and then I'm going to show you live examples. The way a lot of people mess up on this exact example here is, let's say you're trading off the 1 minute time frame. Once again, you're trading off the 1 minute candle. let's say this right here is a resistance level. Let's say it's 10:33 a.m. and 58 seconds, right? Now the moment it goes to 10:34, right, 05, right, a few seconds later, this is the 10:33 candle. This is how the 10:33 candle closed. So this right here is the 10:33 candle. I'm going to show you an example of this. This is a 10:33 candle. It closes. The next candle at 10:34, 5 seconds, looks something like this. Now, what a lot of people do right here is they're like, oh man, it's breaking out of my critical level. It's breaking out of my critical level that I established. It's only been 5 seconds into the candle, be it a 1 minute or a 5 minute. What a lot of people do here is they immediately buy. And then once the candle gets closer to the closing period, let's say it gets to 10:35 and the candle has fully closed on a 1 minute candle, the candle sometimes ends up looking like this. Now guys, if the candle looks like this, you have to understand that at a point during that minute, at one particular point, this candle looked full, strong, and green, something like that, right? It looked very strong at a point. So what happens is during this point, people chase. There's fear of missing out. People don't want to miss out on the move, so they start buying, which surges and creates more buying pressure for that moment. And once that buying pressure dies out, the candle ends up looking like this. So waiting for the candle to close and waiting to see what it shows you is extremely important. So what I use when I use smaller time frames, I always use the 5-minute chart with the 1-minute chart. I use both in combination, right? I want to see what the 5-minute is showing and what the 1 is showing, right? I want to see these close. I want to see a strong close, right? When I like to get into trades, if a stock breaks out of a resistance point, I want to see it close above there. I want the candle to close above that level. I don't want to just see the candle being above that level for 10 seconds, 20 seconds. No, I want to see the candle close. That itself is going to give me a high confirmation on the trade. So now let's jump over to our chart and let me show you some examples and let's break that down. All right, so if you guys take a look here, I'm looking at stock Apple. I have the 1-minute chart and I have the 5-minute chart. So now when you look at this right here, let's look at the 5-minute first. You can see stock Apple opened up strong, got rejected, rallied right into 252.5, resisted from there and broke out. So that's our level of support on an intraday time period. So we are watching for this maybe consolidation period and then maybe a continuation or maybe a sell-off. So right now, when you look at this time frame, this is what we see on an intraday time period, right? So on this intraday time period, this is where a lot of people tend to mess up. Where a lot of people tend to mess up is the moment they see a candle like this, they go, okay, it's breaking 252.62. It's going outside of this line that I established. I should short or buy puts. Now, what you have to understand is, like I mentioned, you do not want to trade off the 1-minute candle, right? If you don't want to get trapped into fake moves up or down, you want to use it with the combination of the 5-minute. You want to use a little bit higher time period, right? Some people even like to go to the 15, right? And like I said, that's all up to you. It doesn't matter. There's no right or wrong, but that's up to you, right? But now let's understand price action. Now, right now, this is how the candle looks. Now, right now, this candle, what it's showing us, it's showing us that we should short, we should enter. Now, like I mentioned, when I'm trading off the 1-minute candle, I don't care. I like to wait for the candle to close strong. I want to see a strong close. So right now, the candle hasn't closed. This is a 1-minute candle. Each candle here is showing us 1 minute. This is a 5-minute candle. So what I want to see is I want to see this candle close below that level, and I want to see it continue. That's going to show me a strong move down. Now, where a lot of people mess up is they see this high volume bar, and they're like, wow, that was aggressive selling. Sellers had control. Not really. Look at the candle. Look at the buying pressure kicking in. So it's very hard to tell who had control because look at the candle. Yes, the candle was red, right? But look at the wick on the lower end. So right now, there's no trade. Right now, what a lot of people are doing is a lot of people are entering, they're shorting, they're buying puts. And now if you look at this, constantly you can see what's happening. You can see buyers keep stepping in. Buyers keep holding the stock price. So if you guys, once again, take a look here, you can see stock goes down, buyers step in, and they're bringing the stock price up. This is also a formation of a new 5-minute candle. That new 5-minute candle is showcasing us that this is holding. This does not mean you should buy here. I'm not saying buy it because what happens, the traps throw people off. Goes like this, traps, traps, and dump. Or maybe trap, continuation. Right now, there was no trade, right? That's what you guys have to understand. When you go back to this, you'll see that at a point, this candle looked like a strong sell-off. But this is the 1-minute candle, guys. This is a 1-minute candle. I would not trust this candle. I would not trust trading off solely a 1-minute candle. I would wait for this. I'd wait to see what this shows me. This is showing me that on a 5-minute, it closed down here, but there's buyers stepping in here. So I have a support level at 252.62, but this is where buyers are exactly stepping in. They're stepping in around this area, right? Once again, it's an area, not an exact level. So around 252.45, around that area, buyers are stepping in, buyers are holding. Now, once again, that does not mean that this is going to go higher, and that also does not mean this is going to go down. All it means is that buyers are sitting here, that if I want to short, if I want to buy puts, or if I am thinking or want confirmation that this is going to go down, I'm going to need this to break this area because buyers stepped in here, but right now buyers are not there, right? If it can go down there and buyers do not step in, that will give me a high confirmation. So this is one example. Let's fast forward. So let's fast forward and see what's happening. So I fast forwarded and now you guys can see what happened to price action. This is where a lot of people got trapped. My original support area was 252.62, right? Like I mentioned, it's going to be up or down. A lot of people, what they do is the moment the stock gets below their exact line, they short, they buy puts, they get trapped, and look what happened to the stock's price. That's why it's extremely important to wait for it to get out of the area. It's extremely important to watch time and sales in level 2. And the main thing is it's extremely important to wait for the candle to close, guys. Wait for the close. Look at both of these candles. They're showing us buyers are sitting right here, shooting the price right back up. So it's very important to wait for the candle to close. The people that did not wait for the candle to close probably lost money by not waiting and just being very impatient. All right, so if you guys take a look right here, looking at stock Apple, now we can see that around 258.6, right, around that area, not exactly at that price point, there's resistance, right? You can see starting off from the day, stock wasn't able to hold. As it wasn't able to hold, you can see it started dumping, right? So a very, very important area around here. Let's just reconfirm that level. Let's reconfirm that area. You can see around this area. Now, I'm not going to put an exact line there. I'm going to put an area knowing that this area right here is a major resistance zone, right? This right here, once again, is a major resistance zone that we should be heavily focused on. I'm just going to move this down a little bit just so we have it going on. Now, as the stock keeps moving, if you take a look right here, this is where a lot of people, this is where everyone is entering. Because what everyone thinks is okay, it's breaking out, strong move up. Now, smart money is waiting. Smart money is saying, no, I'm not confident. That's a 1-minute candle, right? Even if I get a continuation, that's a huge move up. There's got to be a break somewhere. There's got to be a break in here. There's no break. I'm not taking the trade, right? So as that happens, look at the next candle. Now, the next candle shows us a little bit indecisiveness between bulls and bears. You can see bulls and bears are very indecisive. So when we look at that, we see right here on the 1 minute candle that it gets rejected. There's rejection. Now, does this candle mean that the stock is going to go down? No, it does not mean that the stock is going to go down. The only thing this candle means right now, the only information that we have right now, is that bulls and bears are indecisive. There's no control. Now, obviously, if it can continue, that'd be a strong sign because the stock took a break. But if it doesn't, that means we should not buy because that's a false breakout. That's a weak breakout. That is a trap. Now, what a lot of people did here, once again, is a lot of people entered, a lot of people bought. We waited. Now, if you look at the next candle, we are waiting for the close. Remember, we're waiting for the close, right? In this candle, the candle didn't close. This is how the candle looks after the close. During the close, the candle, not during the close, during the candle didn't close. The candle at one point looked strong like that. During that one point, what a lot of people do wrong, especially on a 1 minute candle, it's not the best thing to do. Avoid doing this at all times. A lot of people buy. So a lot of people bought when the chart looked like this. But when the candle closed, the candle ended up looking like that. Now, me seeing that, I already see that, okay, it goes up, sellers step in and they reject. Cool. I know sellers are going to kick in. They're going to reject. It's not going to be a clean move up. I'm still not confident. I see rejection. I want to see that rejection area get taken out. So I'm like, all right, let me wait for the next candle, wait, next close. Maybe that'll give me confirmation. Consolidation, cool. Let it consolidate. I want to see it consolidate because consolidation is showing me it's taking a break. More consolidation, still cool. More consolidation. This is phenomenal. I'm liking how this chart is setting up. Chart makes a huge move up, and now it's kind of giving me a bull flag, if you want to call it, right? It's taking a break. A break on 258.8 is going to show me a continuation move, and I will then get in, right? But I like the setup. Right now, I like the setup. What tends to happen? Boom. Setup gets very, very choppy. So what happened here is I saved myself from getting into a bad trade where a lot of retail traders entered and got caught up in this one trap. They saw that the stock was above and they entered and they got trapped and now they're losing money. Me, I'd rather wait. I'd rather wait for the confirmation and take the trade from there. Now if we keep going, you can see same thing again. Stock goes in that zone, 1 minute candle, and now I'm going to open up the 5 minute. Now if you guys take a look at the 5 minute, you can see same exact concept. Keep going, goes right in this area again, gets rejected. Now just because it gets rejected doesn't mean you should short, doesn't mean it's going to go down. That's a good sign, especially on a 1 minute time frame. Now you can see same concept over and over and over and over again. It's consolidating, it's taking a break, consolidating, taking a break, right? Right now, there's no trade. That's where the trade starts kicking in. Now, when you look at this, remember at 25.8, we had a major level. Now, 25.8 is a level that I'm heavily focused on. Now, if you take a look at that 25.8 level, you can see that level that I couldn't break. It goes, breaks that level, strong break, consolidates, right? This is a good consolidation. I like this consolidation. Continuation. Boom. That is giving you your entry. Why? Because it took out the first wall. When it took out the first wall, the candle closed. It's consolidating, isn't giving us a strong move up or down. Boom. Now it's showing us that the buyers were able to take out that wall that sellers put out. Now we have a high confirmation. And now obviously if you look at our 5 minute chart, you'll see the 5 minute chart looks phenomenal. Look at how the 5 minute chart's looking and look at the 1 minute chart. 5 minute chart looks great. Why? Because look at this. Strong breakout. We see a doji, we see a break, and we see a nice continuation. And there's volume too. Volume is obviously picking up. And then on the 1 minute chart, you can see it's looking nice, it's looking clean. And now just one thing that you guys want to keep in mind with the 1 minute chart is when you are trading off the 1 minute chart, you're going to see a lot of noise. That's why, like I said, I prefer to use both. Using the 1 and 5 so you can actually see the bigger picture, you can see what's going on. But the whole idea is, guys, that you don't want to get trapped into these type of plays. You don't want to end up buying here because you see a strong candle, you see volume, and then next thing you know, you buy and the stock goes down. I don't want you guys to get trapped into these type of plays. I want you to find high probability plays, watch it, and say, okay, where will my entry point be, right? Did the candle close? Is it looking like a strong play? Okay, no, it failed. Cool, right? I want you to be patient where you don't get into the moment where it's like, oh, I don't want to miss out. I could have bought here, I could have bought here, I could have bought here, I could have bought here. And then you buy and it dumps because you're not the only one that's going to be taking that trade. There's going to be a lot of other retail traders that are getting trapped, and I want you guys to avoid that. Once again, just to recap everything, there's a lot of traps set out in the market, guys. Understanding that, once again, is a very important concept. And number two, knowing how to avoid it, knowing how to put yourself in the best situation out there is also very important. And just approaching each and every single trade or every single chart from an idea that, hey, if it was this simple, everyone would make money. What are the market makers doing? What are the market participants doing? Are they creating a fake demand? Are they driving this up just to push people out? What's going on? When you start questioning these type of things, you'll start putting yourself in a situation where you'll have higher success. You'll have higher probability in a lot of trades. So the whole goal is to understand the whole market from a macro point of view.